because I am personally invested in other syndications, not just my own. So I invest in my own properties, but I also invest in other operators as well. And these are the 5 things that I look for when I'm looking to invest in other operators. I'm currently right now in 21. Today, I actually just committed to my 22nd. And then I actually looked at my 23rd today as well. So haven't made a decision on that 23rd one yet. But our group is also closing another pretty large deal. It's about a $50 million property out of Charlotte, North Carolina, not this week, but next week on Friday the 15th. So we're actively in the space. We're actively raising money in the middle of this whole COVID-19, as crazy as you might think I am. It's definitely been challenging. And I told my wife the other day, it's been the hardest I've ever worked, I think, is trying to raise funds in the middle of COVID-19. But we actually accomplished the goal, got it done, and we're going to be closing this thing on Friday of May 15th. So the first thing on your list that I want you to write down is you want to try to find an operator. And I'm going to talk to you as if you're a passive investor, just so you know. So because these are really my rules when I'm looking at it from a passive investor's perspective. So even though you might not be a passive investor yet, you might eventually be, or you might be putting your business plan together for when you're structuring things for your own group. And those will be important all around. So first off, the first thing you need to look for is somebody that has a track record and success and background in business, okay? And the reason why that's important is because you want to make sure that when somebody is buying these larger assets, which our group only looks for units that are, 100 units or more. And now we've kind of reset our criteria where the minimum we'll acquire is 20 million, on the high end about 75 million. So we're looking, when I place my capital, I want to look for somebody who has a successful background in business. And make sure when you're writing this down that you actually underline, highlight, circle the word successful. And the reason why that's important is because I bet every single one of us on here knows somebody that knows how to run a business, but they know how to run it into the ground, right? They're really good at running things into the ground. And you don't want someone that just knows how to run a business, because you want to make sure that they actually have successfully run a business, and they know how to manage people. They know how to put in systems and procedures and processes in place. They know how to set KPIs, these key performance indicators, to know how the property is performing at any given point in time, so that they can actually pivot and make changes as necessary, okay? And so number one is making sure that you find somebody who has a successful background in business. The second thing is you want to find somebody who is a full-time operator. Now, this is something that might, make some people cringe a little bit when I say this, but people who want to get involved with multifamily, I do not believe that they should be trying to hold down a 9-to-5 job and trying to manage other people's money in the nights and weekends. I've worked very hard for the money that I have, and I know everyone on here has as well. And I want to make sure that my money is being monitored on a full-time basis. And any of you who have actually closed one of these larger deals will probably nod your head and say, yes, this is a full-time job. Yes, I have somebody managing the property because I have a property management company, but the asset management piece of it and all the back-end stuff is a full-time job. It's not something that you can do in nights and weekends, no matter who tells you that. And that's, for me, I want to look for a full-time operator. And so for somebody who's getting started and maybe they still have a corporate job, my suggestion to those people is go find a solid partner that is full-time in it and go join their team and help them in a different aspect, in a different area, to build your track record, to build your credibility. And that way, when you're ready, you can step out of your 9-to-5 and actually do this full-time. And I promise you, your investors will appreciate that as well. So number one, successful background in business. Number two, I want to make sure that they're a full-time operator. And our 3 partners in PassiveInvesting.com, myself, Daniel Randazzo, as well as Brandon Abbott, we're all 3 full-time in the business. We have our whole team that's with us as well, that's full-time managing our assets. The third thing I look for is I want to make sure that there is more than one partner or more than one operator on the team. So ideally, I want to see 3, but at a minimum 2. And let me tell you the background as to why I decided to come up with this. So I was actually in New York City at a meetup similar to this. And I had been to that meetup several times. I actually try to go to that meetup a few times a year. Obviously right now with unable to travel, it's been a little bit challenging to do this, but that is that in that meetup, there's a guy that I had met a couple of times, and we always go around the room. It was more of a mastermind more than a meetup, but we go around the room and kind of talk about different things we're having challenges with. And one of the things that he brought up is that he had recently, about 6 months prior to that time that we were there, he had invested in a multifamily deal out of Atlanta, Georgia, or one of the surrounding areas in Georgia. And he invested $200,000 of his own money. And then he also convinced his friend to invest $200,000 of his money. Well, 6 months into the deal, the operator, they cannot find. He kind of went ghost on them. And so now we have $400,000 of these two gentlemen's money that they can't find the operator. And they don't know if the guy just like fell off the face of the earth, like he got in an accident and he's dead, or he just went off to Hawaii, or not even Hawaii, some other country, right? And just skipped town. But the property is still there. They can still talk to the property management company, but because they're passive investors and aren't on the operations team, the property management company won't talk to them about anything. The money is held up in limbo. They have no way to get access to their funds. And the kicker is that, you know, you might think, well, why don't they just sue them? Well, the operating agreement says that they have to, before any suit gets filed, they have to arbitrate with the person. Well, how do you arbitrate with somebody who you can't find, right? So now they're trying to get a judge to actually order them to that they can actually file suit or get their money back or something out of this project. And so it's been a bit of a nightmare for them. And all I can imagine is being the guy who convinced his friend to put in the 200,000, right? If I was in that situation, I'd be like, hey buddy, here's 200, here's another 200,000 if I had it, to give it to him so he didn't have to mess with it, right? I don't want to ruin a friend over this. But that's the reason why I came up with that, because the chances, if you have two or more people, of both of them going ghost, now they have to be non-related, so it can't be husband and wife, right? Because they could obviously go ghost on you. But if there's 2 or 3 people that are the main operators on a project, the chances of all 3 of them going ghost on you is a lot less. It's also one of the reasons why with our group, passiveinvesting.com, we don't get on the same plane together and go to conferences or events that we're speaking at or anything like that, because we don't want the plane to go down and then nobody to be there to be able to run the business. And each one of the partners is actually cross-trained to be able to do the other partner's job. And so if one of the partners does go down in an airplane or gets ill or car accident and they are incapacitated for any reason, one of the other partners can come alongside and fill that role temporarily until somebody else is found to be able to fill those responsibilities. So that is an extremely important piece that a lot of people miss. And I don't want just one partner and then multiple people underneath them working. I want to have multiple main people that are the main operators in that project. So number 1, successful background in business. Number 2, I want to have a full-time operator. 3, I want to have at least 2, ideally 3 partners. So I call that more than one partner. The 4th thing is that the deal itself, I want to have preferred returns. And as a passive investor, I feel like that's a very important piece to the investment, because these investments usually cannot go forward without those passive partners, right? And so in our group, I'm not looking for investors to just come in and just do one deal with me and I'm going to go off, right? I want people that want to be able to invest with me for decades upon decades upon decades, and I want to build my wealth and I want to build their wealth together. And so for me, the way we've developed our entire investment strategy is to really protect the passive investor, because we want them to continue to invest with us. We're not just trying to get as much money as we can as ourselves, which is one of the reasons why we always tell our investors that, listen, at the end of the day, we do 70-30 splits after our preferred returns. And after that preferred return, we obviously have projected numbers that we're going to have when it comes to the full cycle of the deal. So if we're doing a 5-year or a 7-year hold, we might have a 15 or 16% IRR, or some of you might be more akin to the annualized return. So it might be 18, 19, 20% on an annualized basis. But if we, for some reason, at the end of the deal, we're not hitting those numbers, our group is willing to give up a portion of our 30% to make sure our investors are getting those returns. And I think it's important, because the moment you start giving up some of your returns to your investors is the moment they know that they can trust you, and that confidence builds up in you. And I think I was just listening earlier, not listening. I was talking to Danny Randazzo, one of our partners, earlier today, and I told him, I said, we have amazing investors in our group because in the middle of this whole COVID-19 situation, we're able to raise almost $20 million to acquire this $50 million property. And yes, it took us a lot longer than normal, but we have a really good, solid investor base, and that doesn't come very easily. You have to build confidence with people. And I tell you what, Yona, I'm going to do something that I'm sure most of your investors have not seen yet. I know some people on here might have seen this, and I know David's asking here, can you define preferred returns? And I will do that in just a minute. Let me share my screen. And you actually, Yona, it says that you've disabled screen sharing, so you might have to enable that for the meeting attendees, I think is what you have to do. There should be a button somewhere on that bar to kind of click to allow them to. There we go. Perfect. I got it. All right. So I'm going to do this little screen share with you, and hopefully on here you can, I don't actually see anybody anymore, but let me see if I can move my screen. There you guys are. All right.
So what I would like, just on the side.
All right, cool. Yeah, I had the chat box that was covering it, so I couldn't see it there. So obviously on your screen, there should be a way for you to raise your hand as well somewhere, I believe. Is there a raise your hand thing available? If there is, raise your hand on the screen. There's not? Okay. Well, how about this? Open up your chat box because I want to ask you this.
Yeah, there is.
Oh, there is? Where is the raise hand thing?
I don't know, but Yitzi just raised his hand, so I guess there is.
By more on the top.
On the top. So
the 3 dots that says more should be able to do that.
Perfect. Let's see, more. I don't have it, but maybe somebody else does. Well, it's all right. So we'll just use the chat box for now. It's not a big deal. So this is something that I've started to I've put into practice, and it has really helped me with what we've actually been able to accomplish at passiveinvesting.com. So let me see if I can open this up. Can you guys see this little triangle here on your screen?
Yes.
All right, cool. So what I want you to do is get a piece of paper out and draw this large triangle on your screen. And when you draw this large triangle on your screen, I want you in the middle to call this and again, I'm not the best artist, especially with a mouse freehand, but I want you to call this the investor triad, okay? It's a big, huge triangle on your piece of paper, just like that. Nice little two-tone one there, I guess. And at the top, I want you to write the word no. On the bottom left, I want you to write the word like. You've probably seen something similar to this. It's no, like, and trust, but I want to drive home a point here, which is why I want you to do this with me. So no, like, and trust. This is called the investor triad. So of these 3 things, I want you to use your chat box here, and I want you to type in there, which one of these 3 things do you think is the most important? Is it no, like, or trust? Which one of those 3 things is the most important? Is it more important for them to know you, to like you, or to trust you, right? No, like, or trust. So we have no, trust, no, trust, 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 trust. It doesn't matter if people like you, so actually trust, trust, trust. Good, we got several people responding there, trust. All right, so whenever I do this, most people will say trust, and then it's usually followed by like. And I have a feeling that some people on here have probably heard me say this before. I know some of the names on here that said this, but somebody put all of the above. So the answer to this is actually the word no, right? And the reason why this is important is because, yes, trust is important. It's extremely important, and so is like. But the investors will never have an opportunity to actually make an opinion as to whether or not they like or trust you until they know you first. So a lot of times we try to focus on that trust just a little bit too much, and it's really important for them to get to know you. But when somebody gets to know you, that's when they start to build confidence in you, and that's when that trust starts to come, right? That's when you start to build that trust. And of course, in order for them to trust you, they have to like you too. And I tell investors all the time, our new investors, I'm like, listen, I don't expect you to invest in our next deal. Matter of fact, I'm fine if you don't invest in the first couple of deals. I want you to get to know our group very intimately. I want you to start to build that likeness about us, because then eventually, once you start to know and like us, that trust will come automatically. And it's one of the reasons why our group puts together so many different things to engage our investors in between deals. One of the things that we actually do that I know not a lot of people do, I know of like maybe one other group that does this, but we do it better than another group. I'll just tell you that. Of course, right? But we actually send out a mailed, actually USPS mailed newsletter to our investors. And it's not one of those kind of, it's not a cheesy newsletter. It's a really nice, high gloss, almost magazine style. We send that out every single month. And it is a lot of work, but they get to hear from us and they get to know about us. And guess what? We want to try to build a fence around our investors as much as we can. And we want them to be listening to us, and we want to be communicating to them. We want them to know kind of how we think, because the more that they do that, the more they're going to like and trust us. And I've heard time and time again also that they get these newsletters and they bring them to the office and they pass them around to their friends. And guess what? Their friends become investors with us, because then they start to know us and they can start to build that likeness and trust about us. And so that's a very important piece that I think that a lot of us miss, because we missed it in the beginning too. But you have to make sure that you do that. And one of the ways that you can build that confidence and build that trust is making sure that you take care of your investors first. And so obviously, going back to this list, number 4 is providing those preferred returns. Now, for those of you who are on here, I don't want you to feel like you're ashamed or anything, but in the chat box, tell me yes or actually do this. Tell me no if you don't really know what a preferred return is. Okay, just say no, whatever. I know at least one person on here doesn't know what it is, and I'm pretty sure he's not the only one. So there's at least 2 on here that don't know what it is. Yona's saying he doesn't know what it is, but I would assume Yona does, but there's at least 3 on here. So real quick, a preferred return is a return on your investment that is, there's 2 different levels of it. There is the preferred return that's off of the cash flows, that are the amount of the cash flows that are coming off the investment during the hold period. And then there's the preferred return on the back end when you actually sell, right? And so what we do with our group is we have a preferred return. So for example, if you invest $100,000 in one of our projects and we give you a 7% preferred return, every year you're going to get, not every year, but your preferred return is going to be $7,000 a year until the operator gets any of the cash flows and gets any of the back end profit. So we're basically protecting you as the investor and getting those first fruits, if you will, and before the operator does. And so, and a couple of things that we do as well is if our group can't make distributions one month, because we do monthly distributions, which is a whole other conversation as to why I prefer monthly distributions, which is not part of these 5, the whole point of making sure that I'm not sure where I was going with that. I got distracted on the whole preferred returns on the monthly distributions there. But the whole purpose of making sure that you have those preferred returns is to make sure that the investor gets paid first, right? And then the operator gets paid second. But what I was going to say before I got distracted is that our group takes it a little bit step further. That if we can't make distributions one month because we do monthly distributions, we don't even take our asset management fee. Because I've been in deals before where the asset management fee is getting paid, but me as the investor, I'm not getting paid. And I feel like there's a big disconnect there when the operator's getting paid, but I'm not. And so I always make sure that we don't take that asset management fee unless those are being given to the investors. That's the preferred returns are given to the investors as well. And so I have Chris asking me, are you doing distributions currently on your properties under management? Yes, we are. So obviously May is still a question mark because we're still waiting on the full reports for May because of the whole COVID-19. So far, all of our assets are still coming in pretty strong. But as of last month, we were able to make our monthly distributions on all of our assets. All of them are well capitalized, have great cash flow on them, and our average income, but the average collections across our portfolio of over 2,000 units was just over 95% for the month of April. And we're thinking it'll probably go down a little bit in the month of May, but we'll have to see. But so far the numbers coming in so far in May have been pretty strong. So again, let's just recap real quick before I go to number 5. First one is successful background in business. Number 2 is full-time operator. The third is having more than one partner. Number 4 is must provide preferred returns. And then number 5 is making sure that each one of the operators has skin in the game, right? And I like to see at least 10%. Okay. Now, some of you might be dealing with some operators that maybe they can't invest 10%. And I'm okay with going below that. But what I like to see at a minimum is at least $100,000, right? And again, whatever deal you're investing in, maybe the minimum is going to be a little bit lower for you because of the size of the deal, if you will, or whatever. But for me, I invest for myself in higher end assets that are minimum 10 million upwards to, I don't know, no matter what the upper is when I'm investing passively, but on the minimum, I want to see the evaluation of that property being at least 10 million, right? And so I want to see at least $100,000 invested alongside the investors and have that skin in the game, if you will, from the operator. Now, I like to see 10%. So our group likes to put in 10%. So this deal that we're putting together, that we're closing on next Friday, our group is putting over $2 million of our own cash alongside of our investors in this property. My wife and I personally are putting in $1.25 million of that $2 million ourselves alongside investors. And investors like to see that. I myself like to see that when I'm a passive investor. So it's an additional alignment of interest that makes the investors feel good and warm and fuzzy inside because they know that you have skin in the game. And what that means is they know that you're going to watch that investment like a hawk because you have money to lose, not just gain. And so they want to see that co-investment alongside it. So those are the 5 things: successful background in business, full-time operator, more than one partner, must provide preferred returns. And of course, I'll throw in their monthly distributions. And then also skin in the game, not every other deal, but every single deal. If I'm investing with them, I want to see that skin in the game. So I'll open it up right now. Hopefully that gave you some good insights for your own kind of search when you're looking to place capital. And of course, if you want to have a one-on-one phone call with me and discuss some of your investment goals, or maybe to kind of talk about different operators I've invested with and who I like and who I don't like and stuff like that. I don't want to do that in a public forum, but if you have questions about that, you want to discuss it one-on-one, you can certainly go to our website, passiveinvesting.com, and sign up to be one of our investors there. And would love to join you in our pursuit for multifamily into the future. So I'll open it up now, Yon. If you have any questions that have come in, or we want to undo mics, we can certainly do that as well.
Sure. So first of all, thank you very much, Dan. Extremely insightful. Always love to hear your opinions and your take on this, especially given your extensive experience. We do have a few questions, and I'm gonna open it up if someone wants to turn their mic in a moment. I just want to, even before that, I want to say in about, maybe we'll take questions for another, depending on how many questions there are, maybe another 10, 15 minutes or so. And then I want to open it up to do the breakout rooms. So we have this really cool feature on Zoom that we're going to randomly, everyone's going to break out into random groups of 3 or 4 or whatever. And then you can do a little Zoom conversation amongst yourself, do a little networking. So we're going to get to that right after the question and answer. So please stick around. I do have a question for you first. I see other people writing in. But of the 21, 22 syndications that you've invested passively in, how many operators, how many different syndicators were those with?
8.
8 different syndicators, different groups. Okay, and they're all multifamily?
Every single one of them.
Okay, awesome. Amazing. So definitely, spread out. You've taken the time to get to know different operators. So, I mean, like you said, know, like, and trust. So obviously you've taken the time to get to know a lot of people.
Yeah. And I think that's an important piece because I've invested with some groups that I will not invest with again, even though I'm still currently with them. And it's helped me kind of develop this list in the future. So I did make mistakes in my first couple of investments of getting with people that maybe I now would not get into. Not necessarily that they're bad people, but they're just maybe not the best at managing assets right now or something like that. And so this has kind of been developed from those experiences.
Okay, awesome. So we have a question from Chris. Did you have a W-2 job when you got started in syndication, or did you burn the boats, so to speak?
Yeah, so my background, Chris, is actually from owning and running. My wife and I started from scratch these medical clinics. They're non-surgical orthopedic medical clinics here in South Carolina. And my main reason for getting into multifamily was because we were paying way too much in taxes. At least we felt we were. And so my wife, kept on saying, that she kept on telling me, she kept on saying, she's the one that manages all the personal finances. And every year she'd come to me and she's like, why are we having to pay more and more money in taxes? And I said, dear, it's because we're making more and more money. And that's a good thing, right? That the more money you pay in taxes, the more money you're making. And then I realized that we could actually have not had to pay as much in taxes if we were actually investing in real estate. And so I built the clinics up, and then I promoted my COO at the time to the CEO, who is still my CEO. And I haven't stepped foot in my clinics for over 2.5 years. And they've been running really well. They had their best year last year. And I've been paying very little, if not, I might actually last year I paid 0 income taxes. They're still not finalized yet, but it's because of the multifamily investments, right? And so that was one of the reasons why I got into it. So I guess you could say I burned the bridges, if you will, because I made a decision on a Friday. On Monday, I promoted my CEO, my COO to the CEO. I stepped out on Tuesday, and the rest is history. And so I kind of burned the bridges, but I'm still the president of those clinics, and I still own them 100%. They're all 100% debt-free. And I also own another business called shopanatomical.com, where actually we sell all types of anatomy models like skeletons and skulls and brains and hearts. And we sell those all over the country and around the world. And it does 7 figures of revenue a year as well. And I have a team that runs that too. So I do have other businesses in the background that's actually, actually generating additional revenue and cash for me, which is one of the reasons why I'm placing capital with more than just myself, because I do have a lot of capital that I need to place, and I hate seeing that liquidity just sitting in the bank account. I want to get it to work and start working for me, even in between deals that I have of my own.
Awesome. Incredible. So we have Jerome mentioned over here. Yeah, we mentioned at the beginning the Multifamily Investor Nation Facebook group that has grown to over 15,000 members. And what's the biggest secret to audience aggregation?
And he says there, are you going to mention the summit?
You're going to mention the summit. We mentioned the summit already, but yeah, let's do that.
Yeah. Well, I would say that it's hard, Jerome, because when people ask me questions like that, where it's like, what's your biggest secret, or what's the one thing you do, or what's the silver bullet, or what's the magic pill, or, what is that one thing? I have to say there's never been just one thing that I've ever done that has produced the results that I have. And even in my clinics, for the clinics that I have, we generate a lot of new patient volume from a lot of the marketing that we do. And I even get other clinics that will reach out to me and say, hey, what are you doing to generate so much, revenue and generate so much traffic for new patient flow? And it's not just one thing. I do what's called a multimodal approach to marketing, or what you refer to as audience aggregation, if you will, right? Which is really just a fancy way of saying marketing, right? What are you doing to market to get so many people to be attracted to you? And it's a multimodal approach. So I have the YouTube channel that I post weekly on, sometimes twice a week. I have the LinkedIn presence. I have the podcasts that we actually generate people on. I'm a guest on other people's podcasts. I do a weekly webinar every single week. And so if you were to put all of that together and say, what is my secret? It's that I do all of those things really well, consistently. And so I would say the secret would be the consistency of it. Because I see so many people that start a podcast, do 20 or 30 episodes, and stop. I see so many people that start a Facebook group, go onto it for 4 or 5, 6 months, get bored with it, and stop. And it's the consistency that will win every single time. And when people start to see you over and over and over, they start to build that confidence and that trust, right? Because they're now knowing you. So my whole goal with my MFIN group is for people to start to know me so they can start to build that likeness and trusting with us. And I have a lot of really well-known syndicators that actually invest with our group. And it's because, number one, they know me, and now they started to like and trust me. And you might ask, well, why are they investing with you? Why don't they invest in their own deals? Well, I had a syndicator just today commit to me on a deal, and it's because he's actually putting a deal together right now himself, but he has an IRA or a 401k that he cannot put into his own deal. So he wants to look for another good, solid operator, and he's investing with me in our group. And it's all about really being consistent with whatever you're doing and not stopping. And that consistency will, at the end of the day, be what wins. So even if you might not have the ability to do all these different things that I'm doing right now, do something, do one thing now, start with it, be consistent, and then start with the second thing and the third thing and the fourth thing, and they will build up. In some months, you won't get a lot. You won't, like, for example, I'll give you an example. It's like my podcast. So it's a top podcast on iTunes. Every month, I don't get a bunch of leads from there for people that want to invest. But like this month, already in the middle of the month, we've had 83 new people come to our website and tell us that they want to be one of our investors. And so since the fall of last year, since October of last year, we've had over 700 new investors come into our website because of all the stuff that we're doing. And it didn't start that way. I started off only getting 5 or 10 a month, and it's just started to build up and build up. And we're talking about 83 new people in the middle of COVID-19, right? Now, we did take a little bit of a drop in the middle of March to the middle of April, where we only saw probably about 40 to 50. But I can almost guess that almost everybody on here would be appreciative if they had 40 or 50 new investors come into their website at any point in time, whether it was COVID-19 or not. But it's all about that consistency and making sure that you're not dropping the ball on various things. Now, to plug the summit is called the Multifamily Investor Nation Summit. If you're okay with it, Yon, I'm going to give a special promo code because those of you who are here, you've obviously listened to me for a little bit. You're obviously serious. And the tickets right now to the summit are $197. And for those of you who are here today, I will give you a special promo code that if you want to sign up today, you can sign up for only $77. So
it's a virtual summit. It's a virtual online summit. Okay, no one's traveling anywhere.
And it's not that we just started doing virtual. We've always done virtual. Right. So we were actually one of the, if not the first virtual events in multifamily that started. And we had over 800 people in January. Looking forward to having probably over 1,000 in June next month. And it's not less than a month away yet. It's about 5 weeks away. And if you go to the website, mfinsummit.com, and I'll just type it here into the meeting thing so everybody can see it, mfinsummit.com. If you type that into your box, you can actually use the promo code webinar77. So webinar77 and get it for only $77. Now, my goal for this is not to make a bunch of money on the event. Yona knows this from last time. I know Jerome was there as well. I don't do this event to make a bunch of money. So the money that we generate off of this, we actually pour back into marketing to bring more people into the event. Because my goal is to actually get as many eyeballs on this event as possible. Because guess what? At the end of the day, I want people to know me. And I also want people to know all of the speakers that are listed there as well. And so Yona is going to be one of our speakers coming up next week as well. So I'll turn it back over to you for any questions. And thanks, Jerome, for that plug.
Okay, thank you. We had actually Jim Morales would like to ask a question live. So Jim, can you unmute yourself? There we go.
Hey Dan, what's up, buddy? Thanks for taking the time today. Big fan of yours. I'm Jim Morales. I'm actually the CFO at Cardone Enterprises. Yeah, that guy over there. I'm budding syndicator on the side as well. A two-part question. Hopefully answer it quickly. And one, I'm curious, I'm assuming you're doing mostly 506C type syndications for your personal stuff. That was the first question. And the second question, maybe for the group, but I'm also looking at this too. What's your opinion on these coaching programs that are out there for somebody that kind of has a background that is already kind of well-versed in this? Are they worth the price of admission, or is it really just fluff? You're overpaying to get access to the club, if you will.
Sure. So to answer your first question, we've done a combination of both 506B and 506C. So because we have a large group of people that I have personal conversations with, most of ours are actually 506B as in Bravo. So they tend to be a little bit more hands-on, and almost probably every single one of our investors has my personal cell phone number. And so we communicate directly with them and have we can accept up to 35, of course, non-accredited investors in there. We just can't, obviously, with a 506B, openly market our projects or offerings either. So we've done a combination of both 506B and C. And I know Grant does mostly 506C, he's only done 506C on his. And I know he's also doing a Regulation A, which we haven't gone down that road yet either in the fund model. And to answer your question about the various coaches and mentors out there, the ones so I have a coach, right? I have a mentor, and I have right now that helps me in the multifamily space. I've had him since the very beginning. And when I went to seek a mentor, my whole philosophy on mentors is that I'm the type of person that's willing to pay more to get direct access to that coach, that main person. So the one who actually has been the one putting deals together. And I personally don't want to go through a coach. I mean, I'm not a coach. I don't want to go through a student coach or a sub coach or a sub mentor. I'm willing to pay extra to get access to the guy. And so my mentor, I have direct access to him. I have his direct cell phone number. I can call him anytime I want. Matter of fact, today he actually called me. He had a question for me about something. So I want to make sure I have that direct connection with them. And honestly, if you have a mentor that you're not eventually helping out on the other side, you probably have the wrong mentor. And my mentor has told me several times, like, hey, the stuff that you are doing is improving me as well and improving my business. And I've seen two things recently that he started to do that I started first, and now he's doing. So it's really exciting to kind of see that. But bottom line, I would say is find somebody, a mentor that is actively doing deals now, not someone who used to do them 5, 10, 15 years ago. Find somebody who's doing it now and be willing to pay up, because it will reduce your learning curve. And the first deal we put together was an $8.9 million deal, which I never thought my very first deal would be that high, but it was a 130 unit property, $8.9 million, did $2 million in renovations. And hopefully the next couple of months, we're going to be doing a refinance on that one for about 16 to 17 million. And then eventually, of course, in the next probably 2 or 3 years, selling it. But I don't think I would have gotten that deal, nor some of my other deals, if I didn't have that mentor alongside me. And now we're doing really big deals. I mean, this is our second $50 million deal we've done in the last, 7 or 8 months. We closed the last one in October of last year, and this one we're going to be closing on May 15th. So thank you for bringing that up, Jim. And hopefully maybe one of these days we can get Grant to be on the summit too.
All right. We do have a few more questions here in the chat box.
I'll put a plug in.
Yeah, there you go.
All right. Thank you, Jim. I appreciate you coming on here today, and everyone else who's joining us. I'm going to get a couple more questions here, and I would love to get to the networking, because I don't know. We can go all night, truthfully. If anyone wants to stay here, but no, just let me scroll back, because I saw a few questions up above that we missed. So DJ, Logan asks, are preferred returns typically associated with less participation in the upside? If so, is that a disadvantage of having preferred returns? And I think you did touch on that. There's two different types of preferred returns, on the cash flow and on the upside.
There are. So does it give less returns on the upside? Yes, it does. But to me, there's usually plenty of money on the upside to incentivize the group. So one of the things that I also like to see, because there's preferred returns, is I actually like to see a second hurdle in the waterfall. So I don't mind if they told me they're going to give me 16% return. If they actually achieve that 16% and outperform the property, am I okay if they split, instead of 70-30, they split 50-50? Sure, that's fine with me. I don't mind giving them that extra spread. I want to make sure that they're motivated to continue to outperform the property.
Awesome. Actually, I have a few more questions here, but I actually have a question for the group. Dan had an amazing presentation, presented 5 red flags for investing passively. Anyone else? I mean, obviously there could be 10, right? There probably, I mean, you mentioned there's yellow flags and maybe things that are, but does anyone else have anything that to them would stand out to be a red flag? I mean, there's obvious red flags that would stand out to me if when you're doing your due diligence on the operator themselves, if they've had any sort of troubles, with the law or any things like that, which unfortunately have been the case. But if anyone else has any ideas or want to throw in?
And maybe they're not red flags. Maybe you have some yellow flags, right?
Right.
Because there's definitely some flags that are considered yellow flags or maybe kind of make you pause and ask additional further questions as well.
So Chris says multiple capital raisers, names not on the GP list or PPM. So that could be a yellow flag over there probably. You don't know really who's bringing in the capital or who's handling the deal.
Jim is saying here, high LTV or loan to value. What would you consider, Jim, as a kind of a yellow flag or cautionary flag, if you will, on how high you're willing to go as far as your loan to value?
Well, I think now, I mean, you were seeing a lot of deals last couple of years going as high as 80, right? 80% LTV. It sounds like you can't even get those deals anymore. Or at least you're paying through the nose for them. At least that's what I've heard indirectly. I mean, Grant's more in the, 60%, 65% maybe. And it seems like Fannie and Freddie have kind of tightened up some of their standards. So maybe you can get higher through a bank, but you're also playing with fire right now, especially with all the shakeout that's about to happen. So right now, I'd probably shy away. The returns might be greater, but you think you could run the risk, especially if there is some fallout on rent collection. And I still think personally it's a little too early to know if we're out of the woods there. I know March and April and maybe even May is coming in a little bit over expectations, but I'm a little more pessimistic that that's going to continue if the longer this goes on. I think people are spending what they have saved away now, and that's going to burn off pretty soon, and you may start to see some shakeout, especially in Class C. Which is actually a question for you, Dan. What classes do you kind of focus on? Are you kind of the whole spectrum, or you have like a specific niche that you focus on?
We actually focus on B plus, and then the A class properties. So this deal that we're closing next week is actually an A class property built in 2014, paying about $215 a door on it. And I wouldn't be surprised if Grant bid on it too. We outbid him.
Lower?
Say again?
Oh, look at that. I was gonna say, because you go with the higher classes, is your preferred return typically a little bit lower than what you would offer for a B minus C plus class property?
So typically our preferred returns anywhere between 7 to 8%. Obviously, we don't always hit those preferred returns on some of the Class A's, so that we actually do a cumulative preferred return on ours. So that if we don't hit it one year, it rolls over to the next year. And if we don't hit it completely by the time we actually sell the asset, then the investors get made whole on that preferred return before any other distributions are made.
Okay. So we got a few more points here about the red flags. Multiple capital. We said that they ask for money on the first interaction. Yeah, Jerome, that's a big no-no. Exit cap rates lower than entry cap rates. Very good. Renovations coming out of CapEx budget only. I mean, you're gonna have some. What do you mean by that, Chris? That you would have capital. You can turn your mic on if you want. And Jerome wants to say a little on cap rates.
Yeah, all I mean by that is if you're looking at the financials and you see that they are putting aside reserves, CapEx reserves for, say, a lender or something like that, and they have nothing allocated for a.
Gotcha. Okay. Also on the lending side, starting to see loans players 65. Okay. Jerome, you want to give your 2 cents on cap rates, and then we'll get right into the network. Oh, actually, I saw 1 second. There was someone asked up here, Han, I don't know how to pronounce her name. What is your average cap rate on your exiting project, and how will you see new challenges and opportunities in the coming trends? All low rate and potential refi leading low mortgage payment versus high rental income. You want to shy away from crowded areas and move away from downtown. So a multi-faceted question over there. I don't know if you want to take it now or later.
Sure, I'll answer this briefly, and then there's definitely some nuances in there. We can talk one-on-one, Han, if you want to jump offline a little bit and discuss that further. As far as the average cap rates, our group is not always looking at just trying to get the best cap rate, right? We look at the cap rate as a litmus test of how strong the market is, and it gives us a good indication as to how strong the market's going to be, could potentially be when we go to exit the deal. Because a lot of people look at these cap rates and go, hey, maybe I should just go ahead and chase from some 8, 9, or 10% cap rates, but usually you're going into some tertiary markets that aren't as good, right? And it'll be a lot harder to exit that deal on the back end. And for us, if we spend time, energy, and effort, increasing the value of a property by just making the math easy, $100,000, when we go to sell that property in a 5% cap rate market, we've increased the value by by $2 million. But if you do that in an 8% cap rate market, you've only increased the value by $1.25 million. And so you definitely have the ability to get better returns as long as you know how to perform on those assets. And our group doesn't usually go to downtown areas. Those aren't the Class A's that we look for. So our Class A's, I kind of like to call them affordable Class A's, if you will. So we're not looking for, you know, $4,000 or $5,000, $6,000 a month that are in downtown Miami or downtown LA or New York City or anything like that. We're looking for suburban, so away from the downtown areas that are still in between about $1,300 to $1,500, maybe $1,600 a month. So we're not trying to be in that, you know, a really a high end, you know, kind of urban infill areas, if you will. So hopefully that answered it a little bit. I definitely see that, you know, my opinion of the future is that we're going to see some discounts on properties. I don't think you're going to see the discounts we saw in 08, because back in 08, there really wasn't a lot of capital in the market. But right now, the market is flush with capital waiting to deploy and pounce on and capitalize on these quote unquote good deals, where instead of seeing your, you know, 20, 30, 40% discounts that you might have seen in 08, you're going to see more of a, probably my guess, 5 to 7% discounts across the board, depending on the asset. And we're already seeing that right now with even some existing deals that have had to be retraded in the middle of being under contract.
Awesome. Thank you again, Dan. Just one more thing before we do the breakout rooms. I would love if everyone could give them their biggest smile. You can take a little screenshot over here. Okay, so Cheese, you can turn on your camera if you want to. If you're not, you're just going to be a name. Okay, there we go. Okay, we got Kyle's big smile. And on the count of 3, I'm going to say cheese. I don't know how to say cheese. Okay, 1, 2, 3, smile. There we go. Perfect. Beautiful. You guys are beautiful. Thank you so much for coming. We're going to go right into the breakout rooms over here, which is a pretty cool feature. We're going to probably do it 2 or 3 times. If everyone wants to, you can jump off. Anyone, feel free to jump off at any time if you want to, you don't feel like staying. But for anyone who's here, I think this is a great opportunity to kind of network. And when you get in, what's going to happen is you're going to see something come up on your screen. You're going to click it to go into breakout room. It's going to take you to a randomly grouped together with 2 or 3 people. And then we're going to stay in there for about maybe 5 to 7 minutes. Everyone should introduce yourself. Maybe say what your real estate experience is, what your real estate, maybe say if you have a goal, especially now, I think, if you have a new goal since this whole COVID thing came about. I think it would be a nice icebreaker kind of question. And here we go. And then, like I said, I'll bring you back here to the main group, and then we can do it again if anyone wants to. So we got, okay, a few people left already, so we're gonna do